Good evening. My name is Adam Hub. I have been a financial advisor for over 15 years, and I really enjoy working in the Minneapolis office with clients, helping train other advisors and just explain some of the different concepts that we work with. So today we're going to go through some very basic fundamental financial concepts. And I just want to acknowledge that some of you guys are brand new to finances. Sometimes people say, I always wish I would have learned some of this stuff in high school or college. And that's okay. It's good to be at that point in time. I just encourage you to kind of absorb the information that you can, write down your questions, meet with the person that invited you offline to get some further explanation and to understand the concepts better. Some of you are going to be more experienced and have been working with finances and money for a number of years. And so I encourage you to just kind of enjoy some of these things, be reminded, and check in on your own financial situation and kind of see where you are doing well and maybe where you could make some small improvements. So I'm going to make some frequent stops along the way. I have this kind of set up into different chunks, and we'll see if you guys have any questions, and we'll see if we can address them right away. Feel free to type them into the chat as I present something, and we'll kind of circle back and talk about them at that point in time. All right, so our company is ClearStep Financial, and we work with any number of people, from someone just getting started to someone ready to retire, business owners, and just walk clients through the process of figuring out what they need to do, what resources they have, and how they can best utilize those resources to reach the future and the dreams that they have. We really like to teach and educate. This is a perfect example of being able to provide education for you on the different parts of money that you can understand better. Whenever we meet with a client, we will do an education process. So the first meeting is always about understanding where you're at and getting a clear picture of your situation, and also providing that education and the next steps that you have. We look at 7 steps to creating financial security. A lot of finances, as we're talking about tonight on the basics, are very easy to understand, are very simple sometimes, but they're not always easy to do. And those first 4 steps that we have are kind of that foundational steps. So the first one is talking about cash flow. We look at how much money we make and how much money we spend. If we're really looking to move forward financially, we want to increase our cash flow, and we can either earn additional income or we can manage our expenses better. And we certainly walk clients through some of those things and some of those decisions that we need to make on a monthly basis. Step number 2 is to manage our debt. We want to eliminate debt to the extent that we can, consolidate. If we have a situation where we have too much debt, we want to have a plan in place to work through that and to move forward. And we want to make sure the debt that we do have is working for our benefit. So there's certain types of debt that are good ways to have. A house, for instance, is an asset that increases in value, and so you need a mortgage. And so we want to make sure we have the right types of debt if we do have any debt. Step number 3 is short-term savings. We all know that life happens along the way, and so we need to be prepared for those types of things. Rule of thumb is 3 to 6 months worth of income to have set aside, but that's only a rule of thumb. Everyone's situation is a little bit different, and helping you figure out how much is the right amount to have in that short-term savings. And then we look at insurance planning. We have life insurance, disability, long-term care. We have connections with other types of insurance. Basically, we want to make sure that if the worst case scenario happens, the family is still intact and is still assets are preserved. Some of those situations are the worst situations to deal with in life, and yet if you compound that with a financial crisis on top of it, it becomes so much worse. So the first 4 are really our foundation. Whenever we're building something, you have to start with the foundation, or you're not going to be able to build what you want to build and achieve what you want to achieve. So we almost always look at all 4 of those steps with our clients. Many times we say, you're doing great, there's nothing to change here, or we provide some little changes, some little nuances to help improve in those areas. Next, we look at long-term savings, and then step 6 is retirement planning. A lot of people, when they think about creating wealth, they kind of push that all together to say, I just want to invest my money and see how big of a pot it can grow. And when you're looking at long-term savings, when you're starting out young, or you have a number of years left before you're looking at retirement, that's exactly what you want to do. You want to make sure that you are outpacing inflation, you're investing wisely, and you're making the right choices along the way. But when you get to retirement, it's an entirely different picture. Some of the benefits that you had in step 5 become detriments in step 6, and we'll talk about that a little bit later. We still want to grow our assets, but we want to preserve them as well. We want to make sure that they do last for the rest of our lifetime as we transition from working and earning a paycheck to living off of the assets that we've built. And then the last step is to preserve your estate. If you've done everything else well along the way, never perfect, but if you've done it well, then you've created an estate, and we want to make sure through resources we have with estate planning attorneys that that it's passed on in the manner that you want to, that it is a family legacy, and that it truly is something that builds and honors that next generation. So those are the 7 steps of our financial plan that we look at. Again, the first 4 are foundational. You're not going to get into trouble if you don't spend more money than you make. And you're not going to get into trouble if you don't get into a whole bunch of credit card debt, right? And so those are the foundation we build, and then we look to increase that with the next steps in 5, 6, and 7. So we're going to look at the just the different ways that we invest money. I had these 2 on the ends kind of set aside. This is where most people are doing a good job, right? Most people have at least some in short-term savings. You have some money in the bank. You might have a money market account. You know that you need access to money on a short-term basis if something happens, if something comes up. And most people have at least something through work. Most employers now offer 401ks or other types of retirement plans through work, and they're fairly easy to set up and to contribute to. And so those are long-term and short-term goals. But a lot of people miss, and when they're looking at their financial plan, is what happens in between those 2 timeframes. Many of us have goals that we want to accomplish, things we want to do before we get to retirement. And so it could be something as simple as a vacation, or as big as a vacation property that you want to own. It could be a kid's college education, or know that at some point in the future you're going to have to buy a car, and it would be great to not have to go into debt to buy the next car that you have. And so we look at these 3 different areas, and we say, how do we balance out the resources? How do we balance out what we can save on a monthly basis to match your situation and what's most important to you? There's some nuances in there, those different types of accounts, and we'll kind of cover that a little bit, or you can talk to the person who invited you and get into some of those a little bit more deeply. So there's really, when we look about taxes and investing, there's 3 different ways that we can invest. For most of the short-term and mid-term, you're going to be in a taxable account. So you're going to get a 1099 at the end of the year, and you're going to have to pay a little bit of taxes on that growth. Not a big deal. The trade-off is that it's accessible. So when we want to spend that money, it's not detrimental to us to pull that money out of that account and to use it for the mission, the goal that we've set for it. Then we get into tax deferred and tax advantaged. Again, most people are familiar with the 401k, where you get a tax deduction when the money goes in. Less familiar for most people is that then it's taxable when it comes out in retirement. And then tax advantaged is the opposite of that, where you pay taxes now, but you don't pay taxes in the future. And there's 3 different ways. They're all very good ways to save money, and all depending on your situation of which one is the most important to focus on, or to what degree that we use all of them. So this will be the first kind of the stopping point. We've talked about kind of the 7 steps that we look at. We've talked about the different ways that we can save money, the different time frames that we'd have. So is there any questions? Kimmy, did anyone type any questions in? Does anyone want to jump in with a question on any of those concepts?
There are no questions on the chat at this time.
All right, I'll give you guys a second and see if anything comes up. If not, we'll move on. So the next thing we're going to do is to talk about creating that long-term wealth, and the most powerful thing that we have is the time that we have to do that. Consistency through time is so powerful. Most people, not most people, a lot of people I talk to think they need to do something really big to be able to be financially successful. They need to win the lottery, as an example. I hear all the time, right? I should have invested in Bitcoin. We won't talk about cryptocurrencies tonight, but they think they need to do something really big. And that is one way to generate wealth, but it's very rare for people to do that. Everyone else has the ability to be consistent through time and create wealth that way. So the first thing we're going to talk about is the rule of 72. Einstein called it the 8th wonder of the world, and it just talks about how money grows and compounds. We age sequentially. We go through school sequentially, and for a lot of purposes, we think sequentially 1, 2, 3, freshman, sophomore year in school, but money actually compounds and it grows by doubling. And so the more doubles we get, the more powerful it can be. So if you take your interest rate, 4%, and divide it by 72, you get 18, and that's approximately how many years it takes your money to double. If you were 29 today, I'd like to be 29 again in some ways, probably not in others. But if I had $10,000 I had gotten for an inheritance or just had saved up and said, I want to invest it, I'm going to put it someplace really safe and I'm going to get my 4% rate of return. By the time I'm 65 and ready to retire, it will have doubled twice. You can see at 29, 40 to 47, and then 47 to 65, I'd have $40,000, and I'd be very, very excited about the future of my financial life. Actually, not really. $40,000 is a nice amount, but it's really not enough to live off of. But since we're working on doubles, a slight increase in our rate of return over that time frame can actually add a lot more money. And so you can see at 6%, it only takes 12 years for my money to double. So over that same time frame, I get an extra double to $80,000. At 8%, you get one more double again at to $160,000. And then if we looked at a 12% rate of return, we get 2 more doubles. And so our one-time investment of $10,000 jumps all the way up to $640,000 by doubling every 6 years. And this is where you get into that 8 to 10, 12% rate of return, is where you get into really creating and generating wealth. So remember, this is a one-time investment. It's not you adding money ever again. And I always like to ask people, like, what the difference for you between the 4% and it's up the 8 to 10 to 12%, right? So you didn't have to work harder. You didn't have to show up earlier. You didn't have to get a degree, right? You had to get some education on your investments, and you had to have somebody or to make better decisions yourself. And that's where you kind of can see that generating that wealth between that $40,000 on one side and the $640,000 on the other. Here's just another way to look at it. This is very common to show as far as when you start saving. So our first example is to save $100 a month from age 25 to 45. Someone gets out of school, gets their first job, they're super excited to save. And whatever happens at 45, they decide to stop and they never start again. So they put 24,000 in, they got 70,000 worth of growth, and they have $94,000. Our second example gets out of college at 25 and has a lot of things they want to do with their money. They want to travel and they want to do all kinds of things, and those are all great, right? There's nothing wrong with all of those. I always say that, you should do those things, but not at the detriment to your financial picture. And so Sally waits 10 years and starts to save at 35, saves for the same 20 years at $100 a month, puts in the same 24,000, but because we lost that first 10 years of compounding. We now only get 20 years of growth, and we only have $44,000 at that point in time. So that time frame, that time value of money is very, very powerful. And you can kind of see that it doesn't take a ton of input, right? $100 a month to start to generate wealth through time value of money and the consistency applied to it. One of the other advantages we have when we're putting money in is called dollar cost averaging. And it's a way to, by putting that money in on a monthly basis, to take advantage of the swings in the market. We always think of swings in the market as bad things, or most of us think of swings in the market as bad things, and I'll talk about that a little bit here in a second. But they can actually be positives for us as we start to invest. So our 6-month example, the first person puts $800 in right at the beginning, and that's a great thing to do. But you can see through these swings, right, it ends up at $10 per share what they bought at the end of the 6 months. And so they haven't gone anywhere. Their $800 is still worth $800. Our second example, we put $100 in the first month. It goes up in value and it continues to fluctuate in value. Now, the key here is when it's under that $10, we're actually buying more shares. So we bought 10 shares the first time, but we bought like 11 shares when it was $9 and 12 over 12 shares when it was $8. The key to this, in order to have this positive rate of return, is that our share price needs to end up back where we started or higher, and then we're able to take advantage of those swings in the market. This is really, for most people, the best way to do investing, because we get a paycheck on a monthly basis, a bi-monthly basis. We kind of budget on a monthly basis with our mortgage, rent. Some of our bigger expenses are all monthly expenses. And so it's very easy for people to say, I can afford X amount of dollars per month, and I'm just going to put it in and be consistent and know that I can take advantage of swings in the market. So this would be the second stopping point. I'm going to guess we might have a question or two here, Kim. There's usually some more here on these slides. But this is, again, we just kind of covered principles of growth, why we invest, when is the best time to start investing, basically right now, because we can't go back in time. But it's always a good to start now because we can improve the future that we have. So Kim, is there any questions?
No questions yet.
There's no, okay, so you can also ask a question at this moment for Adam. If you unmute yourself, you can do that and then ask a question. If you're on a cell or if you're on your computer, feel free to do that. We'll give it a few seconds here if you do want to ask a question. Okay, we'll get started.
Wow, I must be doing great, huh, Carla?
Well, so Adam, we don't doubt that you're doing great. We know that you are a very strong educator.
Thank you, Carla. So the next thing we're going to look through is just investing and what you invest in, right? A lot of times when I'm going through that rule of 72, people say, I get how the numbers work, but how do I get a higher rate of return, right? And so we're just going to cover some different things. This is kind of a very busy chart. And all it really talks about is that there's different ways that we can invest, right? So many times people have heard of large cap or small cap or real estate investing, commodities. They all tend to perform at different rates. So some years, if you look at any one of these colors, pick your favorite color on the chart and kind of follow it. And you can kind of see that some years it's at the top and some years it's at the bottom. And we can smooth that ride out by doing what's called an asset allocation or diversification. And so instead of just trying to pick one that we think is going to be the best winner, we look at how do we asset allocate, how do we diversify, how we invest our money to smooth that ride out. I'm going to talk about that a lot, right? That the ride can be bumpy, but we can smooth that ride out by the choices that we make. So this is the S&P 500 at the major inflection points. Used to be a little bit more dramatic before we had this huge run up from '08 to when COVID hit. But there's still huge drops in value. If you're not familiar, the S&P 500 is just the biggest 500 companies in the United States. And it's kind of a good barometer of how the entire country is doing. So we can see we had a couple of huge moves, right? 2000 to 2002 is called the tech wreck. And then from 07 to 08, we had the housing market crash. And there are huge drops in value. We also had a big run up from 08 all the way up to 2020. So a couple of things that I point out, right, is that if we're able to take and invest $1 or invest some money right at the beginning and draw a straight line to the end, we would notice that at some points in time we're above that trend line and some points we're below that trend line, and that's to be expected. Also, with the time in the market, if you would have happened to invest on October 9th, 2007 at the very worst point to invest, right, the very highest point, and then you didn't look at your statement for a very long time and you waited until March 23rd, 2020. So you went from the very worst point here before the market started to correct, and you went to the very worst point here when it bottomed out. That's still almost over a 40% gain in value from that worst to worst point. So a couple of things that I always point out here is that the market tends to, with the exceptions of those huge drops in value, to grow over time. And we almost never invest a client straight into the S&P 500 and say, enjoy the ride. We almost always, right, we will work with different types of strategies. I'm going to cover those in a little bit. Works with different ways of investing to make sure that we smooth the ride as much as possible while taking advantage of the growth opportunities here. One of the huge things that we have to deal with is behavioral finance is kind of the technical term, or the emotion of investing, right? It's really easy when you put money in to say, you know, this is going to work out great. I'm super excited. I have this goal or dream. It's much harder, if I go back a slide, right? It's much harder when the market drops by 50% to stay invested and stay committed to our plan. This is one of the biggest things that we do as an advisor, is to make sure that we understand up front and to walk you through those times in the market, right? So we go from euphoria, this is a great time to invest, I should invest more. Usually when that's happening, everyone else is thinking the same thing. And so it sometimes can be not a great time to invest because everyone else is kind of throwing money at the market. And then you get to the bottom of that cycle, to the surrender, right? Where I just can't handle this anymore. I've got to get out. I've got to move my money to safety. And again, everyone else is kind of thinking the exact same thing. And sometimes it's the worst point to make a change or to sell. And so walking clients through these decision-making processes is one of the biggest things that we do. In fact, I see these studies year after year after year, different time frame after different time frame, and they are almost always the same. So if we look at a 20-year return ending in 2020, the S&P 500 averaged 7.5% per year. That's kind of the benchmark that we use, right? It's called a benchmark when you compare it to it. A standard 60-40 portfolio, that just means that I put 60% in more aggressive investments and 40% in more conservative investments. Very common portfolio to do, earned almost 6.5%. And then down here on this orange slide, this is our average investor. And there's a lot of reasons that this is put into place, that the average investor continually underperforms just leaving it in the market. And one of the big things is that emotional component of investing. And you can see that they barely beat inflation. Obviously, inflation's a big concern right now, but beating inflation is a huge thing to do. We want our money to be able to buy more things than they would have now. And that's beating inflation. And the average investor oftentimes well underperforms the market because of the decision-making process along the way, where they move with everyone else and buy and sell at the very wrong times. So part of the math of this is the impact of losses. And so a lot of times we think, just the straight averages of the rate of return will compound out for us. But when you lose money, it's harder to get it back. So when you have a 10% rate of return, it takes 11% to get back to even. If you have a 25% loss, negative rate of return, sometimes it would take 33% to get back to even. And if you had a 50% loss, it would take 100% to get back to even. So if you had put in that $100 that we had talked about before and it dropped all the way down to 50, to go from 50 back up to 100 is 100% a doubling of your money. And that is really hard to do. It's also really hard to stay invested when that scenario happens. And so understanding these impacts of a negative year is very, very important for your decision-making process and for how your portfolio will grow and compound over time. We also have a real return versus average return. It's just a different way to look at how a negative year impacts our portfolio. So if I would have started out and said, hey, we're going to lose 40% the first year, you'd say, I'm not going to work with you. But I'd say, well, we're going to get 40% positive the second year and 20% positive the third year. You might be swayed to say, I could handle that portfolio. You'd average a 6% rate of return, but because of the economics of loss, we would go from 100 to 60, and then from 60 to 84, and from 84 basically back to our $100,000 that we started with. And we really wouldn't have moved forward in our 3-year investing experience. If there was a way to avoid some of that loss, we don't have to capture as much of the upside. So year one, we only lose 10%. First of all, it's much easier for us to continue investing when we only lose 10%. So we only drop to 90,000, and then we only get 15% and 15%. But we're moving forward at a much faster rate because we don't have to come out of that value. That valley that we've created. Interestingly enough, we also have a 6.6% average rate of return. And this is one that really can be eye-opening for people to say the same 3-year average rate of return creates a much different result. So we have almost a $20,000 gain in our second example, basically because we didn't have a big loss that we had to turn around and recover from. So the question then is, which one is more important to you? And I always point out to people that regardless of any of the numbers, this $100,800 versus $119,000, that's what's really most important to you, is the number at the bottom of your sheet to say my account is worth this much money. One of the ways that we do that is we also add tactical management strategies into our portfolios. And so an active tactical strategy has the ability to make dramatic moves to work to protect our assets and to position them in the best way possible. And so this is kind of the example that we use. No one's going to be able to time the market perfectly. Anyone that tells you that they can, you should run away from them and not work with them. But as that market turns over and as we start to see a decrease in value, a lot of times we're also able to see economic numbers, unemployment, a lot of different things that are happening during those time frames. We say we've hit a point where it's time to move to the sideline. It's time to protect our assets, and we'll let the market, the manager will let the market drop. And then we start to see this kind of recovery, and not going to jump in right at the bottom. First of all, because no one knows exactly when the bottom is, but also to start to see that recovery develop and start to potentially speed up. We're also getting positive economic news in this time frame to kind of use as part of the guide for what's going on. And so now we're looking at buying back in as that market starts to recover. So able to avoid a decent amount of the loss, and that's where you look back here as opposed to just riding the roller coaster of the market. We're able to say we're going to stop the losses at some point, step to the sideline, and keep our principal in order to invest at a later date. Any questions?
There are no questions in the chat.
Anyone have a question that they'd like to voice?
No.
I'd like to point out something, Adam, that you addressed and is very important with ClearStep, and that is that we do add that piece of the tactical investing. And just to get more information on that, if you do not know what that is, and that is a uniqueness that one of our uniquenesses that ClearStep does offer. So it's a very important piece to financial preservation as well as possible growth. So thanks, Adam.
It is very powerful as you look at investing, both when you look at the numbers of how money grows, but also when you look at that behavioral finance. How am I actually going to act when this situation presents itself to me? The ability to not lose money when the market's going down, or not lose money to the extent that many people are, is very, very powerful in that wealth creation, wealth generation piece that you're really looking to accomplish. Well, if there's no questions, that was the material I had for today. We went through it pretty fast. Just want to thank you guys for being on and for paying attention. And like I said, if you had questions that popped into your head, things that you wrote down, please follow up with the person that invited you and schedule a time to meet with them and get those questions answered and figure out what you need to do to move your situation forward.
And feel free at this time, if you want to use the chat, you can, or if you do want to unmute yourself, feel free to do that and ask a question at this time of Adam or any of our other financial advisors. And these are key, what Adam presented today, these are key steps in helping you to achieve financial goals, help you to achieve retirement, but also help you get through retirement.
So if your money was invested in mostly where it's going to get taxed at retirement, and you only have maybe 5 to 10 years before retirement, is it worth moving your money into like a Roth so you don't really know what the taxes are going to be when you retire to try to protect it, or is it not enough time to recover?
I think that's a great question. And it's a little bit situational depending on your specifics, but I would say in general that it would make sense to start moving that money over to the extent that you're able to. So there are limits each year for how much money you can put into retirement accounts like a Roth IRA or a 401k. But even if you just have a couple of years, that can really help with the planning process. And you can when you hit retirement, spend the money you have saved outside of your retirement accounts first before you start working with your retirement account money, right? So a lot of times we think of kind of retirement as a set date and then no changes from there, but we really have to think that if we retire at 65, we need to plan on 20, 25 or 30 years of retirement just based on our life expectancies. And so there is a lot of positive we can do by making changes or making decisions even those last couple of years.
And just to add to that, Adam, too, is that Pat? I don't know if
Yeah,
that's Pat. Hi, Pat. So, yeah, so you're talking about conversions as well, right? Where you take your IRA money and you convert it to a Roth as a possible strategy to, to help you with your financial goals. And usually too, what we recommend is where we would do a tax proposal. We have tax people that we work with, and we would actually do that for you so that does it make sense to do some conversions at this time? It may, to shift over into a tax-free status with a good portion of your IRA money. And it doesn't matter if you're in retirement or close to retirement, that that could be a good strategy. We don't know until we go through the numbers and look at the options.
okay, good. It's certainly something I'd like to take a look at.
Yes.
Thank you.
Yes, thanks,
You're
Pat. Thanks for
welcome.
the question. And thanks, Adam. Okay.
I have a question.
Mhm.
If you're investing in an IRA and in Roth, is there any general rule of thumb for what a good split might be?
Again, it's a very specific question. It does depend on your situation. It depends on your income and your time frame. I think for a lot of people, they are investing in a 401k at work, which is pre-tax, and then they're doing their outside contributions into a Roth. That's something I see very commonly. So you can put 6,000 into a Roth on an annual basis. You can put $7,000 if you're 50 or older. And so it's kind of a very limited amount that you have access to. So depending on your picture, it really is going to drive that one much more than a good rule of thumb.
Fair enough. Thanks, Adam.
You're welcome.
Very often too, what we recommend, like Adam had said, it depends on your situation. But make sure you diversify your taxes. We talk about diversification in your asset classes, but also diversify taxes for your future. Like Adam had shown, you have the short-term money, which you pay taxes every year. Then you have your tax deferred status where you pay taxes at 59 and a half or older. And then you have your tax advantage, which is the Roth IRA. It's after tax money going in. So we do recommend diversifying in your 401k and also diversifying outside your 401k in possible other buckets there.
It is very powerful to have both types of money in retirement because you kind of can control your tax situation. So you can take as much as you can out of the taxable accounts in order to kind of minimize your tax burden, and then take any additional money you need out of your Roth or other tax advantage programs, knowing that you're paying a very minimal amount of taxes after all of your deductions and all those types of things. So it's very powerful to have both. You don't really want to focus on just one over the other.
Good questions. All right.
I'm gonna stop the recording and then I'll stick around here for a minute or two if someone wants to drop another question.
Ask a
And,
question outside the recording.